This is a barrel of oil. Not a metaphorical barrel, an actual 42-gallon steel drum sitting in a storage facility in Primorsk, Russia, waiting to be loaded onto a tanker bound for Chennai, India. On the side of this barrel is a stencil marking, Urals Blend, export grade. In February 2022, this barrel sold for $78. Western sanctions were supposed to make this barrel unsellable, or at least sellable only at crippling discounts that would drain Russia's war chest within months. On January 20th, 2026, this same barrel sold for $74, a $4 discount to the Brent benchmark. Not the $30 or $40 discount that sanctions architects predicted. Not the economic strangulation that was supposed to force Russia to the negotiating table. $4. Less than the price of a latte at a Moscow Starbucks, which, by the way, reopened under new ownership 6 months after Western companies fled. But here's what makes the arithmetic devastating for those who designed the sanctions regime. Russia exported 7.4 million barrels per day in January 2026, compared to 7.1 million barrels per day in January 2022. Higher volume, marginally lower price, equals more money. Not less, more. Russia's oil export revenue for 2025 totaled $218 billion. In 2021, the last full pre-war year, that figure was $179 billion. The sanctions designed to cripple Russia's energy income have instead coincided with Russia earning 22% more from oil than before the war began. This is not sanctions failure. This is sanctions reversal, a policy that achieved the opposite of its stated objective, while its architects continued claiming success. Here's what they're not telling you. The Western sanctions strategy rested on 3 assumptions, all of which proved wrong. Assumption 1. Russian oil is fungible, but Russian customers are not. The theory held that major importers, Europe, Japan, South Korea, would stop buying Russian crude, and replacement buyers wouldn't exist at sufficient scale. Russia would be forced to either curtail production or sell at massive discounts to whoever would take the barrels. The assumption ignored the size of Asian demand. China imports 11.5 million barrels per day, more than all of Europe combined. India imports 5 million barrels per day. Between them, China and India could absorb Russia's entire export capacity and still have import demand left over. The replacement buyers didn't need to be found. They were already there, purchasing from other suppliers who could be displaced by discounted Russian crude. By March 2023, China was importing more Russian oil than Germany had ever purchased at the peak of dependency. By June 2023, India had become Russia's second largest customer, up from effectively zero before the war. The customer base didn't shrink, it rotated. And the new customers had no interest in enforcing Western price caps. Assumption 2. The $60 price cap would constrain Russian revenue without disrupting global supply. The G7's price cap mechanism, implemented in December 2022, prohibited Western insurance, shipping, and financial services for Russian oil sold above $60 per barrel. The theory was elegant. Russia could still sell oil, preventing global shortages, but only at prices that limited Kremlin revenue. The mechanism required enforcement, and enforcement required cooperation from shipping and insurance industries. Russia's response was to build a parallel fleet. The Shadow Fleet, a collection of aging tankers purchased through obscure intermediaries and insured through non-Western providers, now numbers over 600 vessels. These ships carry Russian oil to willing buyers without touching any Western service provider. The price cap doesn't apply because the transactions don't use price cap-covered services. At 3:15 a.m. Singapore time on January 12, 2026, the tanker Oceanus Dream, a 2004-built Aframax vessel registered in Gabon and insured through a Mumbai-based provider, loaded 700,000 barrels of Urals crude at Novorossiysk. The cargo will arrive in Vadanar, India, in 18 days. The sale price, according to shipping intelligence firm Kepler, was $72 per barrel, $12 above the price cap, completely legal under the transaction structure used. This transaction is not exceptional, it's standard. The price cap has become a fiction that Western officials cite in press conferences, while the actual market operates according to different rules entirely. Assumption 3. Russia lacks the technical capacity to maintain production without Western oil services companies. Schlumberger, Halliburton, and Baker Hughes withdrew from Russia in 2022, taking expertise in advanced drilling, reservoir management, and production optimization. The assumption was that Russian output would decline as existing wells depleted and new development stalled. Russian production did decline initially, approximately 5% through mid-2023. Then it stabilized. Then it recovered. January 2026 production averaged 10.9 million barrels per day, slightly above pre-war levels. The recovery came through a combination of Chinese oilfield services companies filling the gap, Russian domestic technology development accelerating under import substitution mandates, and aggressive drilling in proven formations that don't require cutting-edge technology. The technology assumption treated Western oil services as irreplaceable. They were merely expensive. Replacements cost more, work slower, and achieve lower efficiency, but they work. The production decline that was supposed to compound annually instead reversed within 18 months. This is where the lie becomes unsustainable. The financial architecture of sanctions enforcement has become a performance that satisfies domestic political requirements while failing to achieve stated objectives. The U.S. Treasury's Office of Foreign Assets Control publishes monthly reports on sanctions enforcement. The January 2026 report cited 847 enforcement actions against entities violating Russian oil sanctions, an impressive number that obscures what the enforcement actions actually accomplish. The average penalty was $24,000. The total penalties collected in 2025 were $67 million. Russia's oil revenue in that same period was $218 billion. The enforcement regime captures approximately 0.03% of the value it's meant to prevent. This is not a rounding error. This is a policy framework that exists symbolically, while the underlying economics flow unimpeded. The European Union presents its Russian oil import statistics as a success story. Imports down 90% from pre-war levels. The statistics are accurate but misleading. Russian crude that once traveled directly to Rotterdam now travels to Indian refineries, gets processed into diesel and gasoline, and then travels to Rotterdam as Indian refined products. The molecules are the same. The paperwork is different. The EU counts this as Russian import reduction, while the actual consumption of Russian origin hydrocarbons has declined by perhaps 40%. Significant, but nowhere near the 90% the statistics suggest. At 9 a.m. Brussels time on January 15, 2026, the European Commission's Energy Directorate held a briefing on energy security that internal calendars classified as Sanctions Efficacy Review. No public summary was released, but sources present described the session's conclusion. The price cap mechanism has not achieved revenue limitation objectives, and enforcement escalation carries unacceptable risks of supply disruption. The conclusion acknowledges what the data has shown for 2 years. The sanctions regime has become a ceiling that doesn't constrain, rather than a weapon that injures. But acknowledging this publicly would require explaining why $200 billion in policy effort produced negative results, a conversation no government wants to have. When institutions do this, they're not managing risk. They're containing disaster. The Treasury departments and foreign ministries that designed Russia sanctions are now managing a contradiction. The official narrative says sanctions are working, while the financial data says Russia is earning more than ever. The contradiction produces increasingly creative accounting. The U.S. Treasury's Russia-related sanctions report for Q4 2025 emphasized that Russian oil revenue was lower than it would have been without sanctions, a counterfactual impossible to verify. The report cited modeling suggesting Russia lost $40 billion in potential revenue due to price cap effects. The modeling assumed Russian oil would have traded at Brent parity in a sanctions-free world, ignoring that Urals crude has always traded at a discount due to quality differentials and logistics. The narrative has shifted from sanctions will cripple Russia to sanctions are denying Russia resources it would otherwise have. This is a retreat disguised as consistency. The goal was revenue reduction, not revenue growth limitation. The goalposts have moved because the original goals were not achieved. Less than 30 days remain before the G7's scheduled Sanctions Review Summit in April 2026. The summit was supposed to tighten enforcement and close loopholes. Leaked preparatory documents suggest instead a focus on messaging coordination and expectation management. Bureaucratic language for explaining why the next phase won't deliver results either. The enforcement options that would actually constrain Russian revenue all carry costs that implementing nations won't accept. Secondary sanctions on India and China would disrupt supply chains that Western economies depend on. Aggressive interdiction of shadow fleet vessels would risk environmental disasters and maritime confrontations. Penalties severe enough to deter violations would also deter legitimate trade with neutral countries. The toolkit has been exhausted. What remains is the management of a policy failure that cannot be acknowledged. While one side manages narratives, the other counts money. Russia's federal budget for 2026 projects oil and gas revenue of $192 billion, conservative relative to 2025 actuals, but sufficient to fund military expenditure of $145 billion, the largest defense budget in Russian history. The budget assumes oil prices of $60 per barrel, creating a cushion where any price above that generates surplus. Oil currently trades above $70. The cushion is substantial. The ruble has stabilized at 87.92 to the dollar, supported by mandatory foreign exchange conversion requirements that channel export revenue into ruble purchases. The currency stability is engineered rather than organic, but engineered stability is still stability. Russian importers can plan, Russian businesses can budget, and Russian consumers can maintain purchasing power that collapse scenarios predicted they would lose. Inflation has moderated from 17% in 2022 to 7.2% in 2025, still elevated by Western standards, but consistent with economic expansion rather than crisis. Real wages have grown 4.8% annually since 2023, outpacing inflation and recovering the purchasing power lost in the immediate post-invasion period. China's role in Russia's oil revenue recovery extends beyond purchasing crude. Chinese banks provide financing for Russian oil development that Western capital markets have closed. Chinese insurance companies cover shipments that Lloyd's won't touch. Chinese trading houses arrange transactions that Western commodity firms have abandoned. The infrastructure of Russian oil commerce has been rebuilt with Chinese components, creating dependencies that will persist long after any potential sanctions relaxation. On January 18, 2026, Rosneft and CNPC announced a 15-year supply agreement covering 100 million tons annually at prices indexed to Chinese benchmarks rather than Brent or WTI. The agreement locks in Chinese import volumes through 2041, guaranteeing Russia a customer base that no Western policy can disrupt. The deal value, calculated at current prices, exceeds $400 billion, roughly twice the total Western aid provided to Ukraine since the war began. India's oil relationship with Russia has produced its own infrastructure. The rupee-ruble settlement mechanism, improvised in 2022, has evolved into a routine payment channel processing $35 billion annually. Indian refiners have invested in Russian port facilities, creating vertical integration that makes supply relationships stickier than spot market purchases. Reliance Industries, India's largest refiner, now sources 40% of its crude from Russia, up from zero before the war. The customer relationships built during sanctions will not dissolve when sanctions end. Russia has diversified its customer base permanently, reducing leverage that Western markets once held. The mathematics of the trap are now inescapable. Western policymakers face a configuration of constraints where every response worsens the position they're trying to improve. Constraint 1. Tightening sanctions requires enforcing against allies. India and China are not violating sanctions. They're operating outside the sanctions' legal scope. Extending secondary sanctions to cover their purchases would affect $600 billion in annual trade with neutral nations, triggering retaliation that would harm Western economies more than Russian revenue would decline. Constraint 2. Relaxing sanctions requires admitting failure. The domestic political cost of acknowledging that 3 years of economic warfare produced negative results is unacceptable before elections in multiple G7 nations. The policy continues not because it works, but because abandoning it would be more costly than maintaining it. Constraint 3. The alternative is military, and military is unavailable. Sanctions were implemented precisely because direct military confrontation with Russia was deemed too dangerous. That calculus hasn't changed. The non-military option has failed, but the military option remains unavailable, leaving policy in a limbo where neither escalation nor de-escalation is acceptable. Russia's position is to wait. Time favors the party earning $218 billion annually, while its opponents debate whether to admit the obvious. Every month of continued revenue funds military production, builds strategic reserves, and demonstrates to other nations that Western economic warfare can be survived. This is what a system looks like when the weapon has been turned around and pointed at its users. The informed are not waiting for official announcements to understand what's happening. Oil tanker rates for Russia to Asia routes have normalized at levels consistent with routine commerce, not sanctions premium emergency shipping. The shadow fleet has become a regular fleet, its existence acknowledged, its operations routine, its economics profitable enough to attract ongoing investment in additional vessels. Russian sovereign credit default swap spreads have tightened from crisis levels of 4,800 basis points in March 2022 to 340 basis points today, still elevated, but consistent with emerging market risk rather than imminent default. The The bond market has priced in survival that the policy framework assumed was impossible. Physical gold deliveries to Russia have increased 280% since 2022, as export revenue converts to hard assets that cannot be frozen, regardless of future sanction escalations. The gold flows through Dubai, Istanbul, and Hong Kong, financial centers that have declined to enforce Western restrictions on Russian bullion purchases. The spread between Brent crude and Urals crude, the sanctions discount, has compressed from $35 per barrel at the 2022 peak to $4 per barrel today. The discount hasn't widened as enforcement improved, it has narrowed as circumvention matured. Markets are pricing in a permanent state where Russian oil trades near global benchmarks, regardless of Western preferences. Defense contractor stocks in Russia have outperformed the broader Moscow exchange by 180% since 2022. The market is pricing in military production funded by oil revenue that sanctions were supposed to eliminate. The stocks would not perform this way if the revenue weren't there. The question is not whether sanctions have failed to achieve their stated objectives. That question has been answered by $218 billion. The question is, who understands the implications of that failure for the broader architecture of Western economic leverage? A barrel of oil sitting in Primorsk, $74 per barrel, 7.4 million barrels per day, and a treasury in Moscow that has received more money since sanctions began than in any comparable period before. This is not sanctions evasion. This is sanctions irrelevance, the demonstration that the most powerful economic weapon in the Western arsenal can be weathered by preparation, adaptation, and customers who don't share Western priorities. Physics doesn't negotiate, markets don't respect intentions, and reality, eventually, asserts itself over every policy that assumed compliance without building enforcement. The divergence between sanctions rhetoric and sanctions results has become impossible to obscure. What happens next is not prediction. It's $218 billion per year, flowing despite everything designed to prevent it.